All right, all right. Lots of questions, lots of questions. All right, let's see what we got. All right. All right. Hey, Christian. What's going on? All right, we got some Q&A here. So we got a boatload of questions to burn through. So lots of questions, lots of questions. Ooh, I got to make sure I'm getting monetized on this. Hold on just a second. Make sure I get that sweet, sweet YouTube money. I knew I could. All right, hold on just a second. Let me monetize this. Make sure that you guys are seeing lots of ads so I can get that sweet, sweet money. Perfect in every way without you. There you go. All right, there we go for that one. All right, hold on just a second. All right, hold on a second. See the stars where they go. That guy right there. And there we go. Are we good? All right, sweet. Turn that off. All right, here we go. So we are live. Sweet, sweet, sweet. All right, everybody. Que paso? Que paso? Beat Army, says Brian, a Navy guy, I guess. All right. Is the music copyrighted? Yeah, probably. I don't even know. Hopefully not. Can they get your whole video? We shall see. Right. So did we talk about this one last night? My man G-Man. My wife's employer is freezing her pension. I'm in the other room because I want to get the horns behind me because I'm evil. Because my dogs are sitting right there and everybody else is upstairs doing homework and whatnot. So I'm in this room here. All right, cool. And I'm on both my channels, Josh Scanlon, heritagewealthplanning.com or youtube.com, Heritage Wealth Planning, and youtube.com, Josh Scanlon. And I just want to keep my eyes on the, ooh, there goes one. Hi. All right. My wife's employer is freezing her pension in January of next year. She'll be 54 that year, as will I. And she can keep all the pension and 401k dollars that she has amassed up to that point. In the same year, they will increase their 401k match to 8% if she contributes 4%. All right. Would it be wise to invest my wife's new 401k contributions plus the match in a money market account? Safe. What's up, babe? What? You don't want to say anything? Okay. I'm just turning it. Would it be wise to invest her 401k contributions plus the match? It makes more tea. No, I'll take some more. Thanks, babe. I got the best wife ever. She just gave me the ice dagger look. Oh, sorry. She told me just do my live stream. All right. So would it be wise to invest my wife's new contributions plus the match in a money market account, seeing how we are aggressive with the remainder of our retirement accounts approximately 5 years away from our retirement age? I figured we'd be tripling our money with no risk. Our plan is to retire when we're 60. All right. Yeah. All right. So basically what they're saying is, look, we're all in index funds right now. It looks like the S&P 500. Wifey gets she puts 4% in. She's going to get 8% in. They're going to retire in a couple of years. Essentially what he's saying is, should they build up the cash? Yes, absolutely. So that's a winning there. You got to have some cash built up, man. And I say if you're 2 years out of retirement, just start plugging money into cash and build that sucker up for sure. Because you've already done all the investments. Hopefully by that point, your investments already there. Like this guy, he got almost $1 million in the S&P 500. No, now just build up your cash account. You're good to go without question. All right. All right. So my man Alan says, I'm going to take my hat off here. I've been searching your videos looking for one on the best distribution plan when you inherit money from a parent. All right. You have a couple on how to best leave money to your dependents, though none on this topic, how to inherit money from a parent. If you have time, this may be a good topic. I'm guessing like us, there are others out there whose parents had a home, some savings, and just didn't see the advantage of seeking advice. From your videos, it sounds like it'd be more or less tax-free. I was hoping there may be a solution to keep it that way for years to come. All right, well, Alan, you're not going to inherit money and it won't remain tax-free. You'll get it tax-free, assuming there's no inheritance tax. I think Kentucky and Pennsylvania, and that's it. I think Maryland, I think Maryland still has an inheritance tax. Kentucky, PA, both have an inheritance taxes, but they don't have an estate tax. New Jersey used to have both. I think they got rid of their inheritance tax, but they still retain their estate tax. And Maryland still has both, if memory serves. I think that's it. I don't think there's any other state who has an inheritance tax. So anyway, when you receive an inheritance, be it unless it's an IRA or 401k or an annuity, it's all tax-free to you under current law. Now, Sniffy is talking about getting rid of that. He's not going to. That's not going to happen. Look, I'd be stunned if they get rid of the step-up basis. So at the end of the day, if the money that you receive from inheritance, other than IRA money and annuity and deferred money, is tax-free to you. Now, the day you receive it, though, you are now assuming that you have a cost basis of what's called the date of death valuation. All right, so that is your cost basis. And from then on, any income that's derived from that account is taxable to you for sure, unless it's in a municipal bond fund. But a municipal bond fund, I'm not a fan of at all. So I wouldn't mess with that. But anyway, if you receive an inheritance of some property and that inheritance pays income in some regard, you will pay income tax on that income. That's just a fact. You don't get capital gain tax. You don't get inheritance tax by and large. But if you were to sell that property at a price above what you inherited it at, then it's going to be you're going to get a capital gain, either short term or long term. If you inherited a house at $100,000 and the next 2 years from now you sold it at $200,000, you have $100,000 capital gain. I hope that makes sense. So I think you might be looking too deep into this, frankly. Not a whole lot you can do. You just get the money, you spend it then, no tax. You invest it, you're going to pay tax on any gains that you have. All right, let's keep rolling here. All right, this is from Alan. I'm retiring, and he just retired. So he retired in 12/31 this past year. I have fully funded my wife and my Roth for this year. Am I allowed to do Roth conversions this year, or do I need to wait until 2021 when I'm retired? No, you can do Roth conversions whenever you want, brother. There's no right or wrong. Obviously, this is past 12/31, but I'm not sure I would be doing Roth conversions while still working, just because you don't want to add income to the from Roth conversions. Oh, hello, puppy. You don't want to add income from the Roth conversions to the income you have from employment. So I think we missed the boat with old Alan here. But at the end of the day, you can do Roth conversions whenever you want, man. There's no stopping you. The question is, what's the most advantageous in that? Until you look at the tax numbers, we don't know. If you're making $100,000 though, and you do a $100,000 Roth conversion, the $100,000 Roth conversion is going to be in the 22% tax bracket. So you're going to lose $22,000 just to the federal government. Never mind the state of Georgia, or ever. I did right on Hendo Dan Don. I did monetize myself. Oh man, Al, they called your bonds. Woo! Oh man. So Al was always ragging on me in a good way, in a friendly way, because he bought these 5% California munis along. I think he said 2007 or 2008. I think he even got them at a discount. Look, I'm not a fan of municipal bonds, so if I could get 5%, hospital bonds at a discount, tax free, I'll take that 100 times out of 100. But they called them from him. So what happens, guys, when they call a bond from you, they just give you the par value. I mean, it's what they give you, and the par value is going to be 100 or. All right, you don't want me. All right. Oh, just be quiet, girl. Oh boy, my wife, she's all crazy. Hi. No, she just tells me to keep doing this. Anyway, so when they call the bonds, they say, "Hey, Al, it's great. You have these 5% municipal bonds. Here's your par value, 100,000, whatever the par value was." And Al said, "Oh man, now what am I supposed to do with this? Sucks." But he's not going to get He's not going to get a 5% coupon now. I'll tell you that right now. Not a municipal bond of any high credit quality. No way, Jose. So, but in the interim, he got 5% tax free for many moons. It's going to be hard to beat that. What we're talking about here. Yeah. I did monetize myself. Thanks, my man. I just did that, so I appreciate it. Gotta get that sweet YouTube money. All right, so let's keep going here. We got Tim says, how does Wellington Fund compare with a Vanguard target date fund? Yeah, let's take a look, actually. Hold on just a second. Let's go to Portfolio Visualizer. Oops, I guess I got to – oops. Don't forget, Dustin Tibbetts will be joining me, or he, on his channel and him on mine on Saturday at 8 p.m. Eastern time. So just FYI, big fan of old Dustin from Jazz Wealth. Dustin's kicking butt, taking names, man. I'm excited for him. I'm excited for Dustin. So he's doing real good. Again, like I said before, Dustin's been a big influence on on my channel, as a matter of fact. All right, so let's go to Vanguard. Can we find? That's the Vanguard Balance Index. Vanguard target. Let's go to 2030. All right, and let's take a gander. Y'all can see that? Yeah. All right, sweet. All right, so we're going to go back to 2007 is when the target 2030 came around. And let's take a gander. I would have no idea. I would think that Wellington did better. Yeah, okay. So Wellington has smoked it pretty significantly, Tim. Wellington's 7.76 over that time frame. The target 6.17 with a significantly higher drawdown. Drawdown, well, it'll tell you right here. Is the maximum loss over a certain amount of time. So basically from the end of October or the beginning of October, they're saying November 2007 to February 2009. Actually, in fact, look at that. It took from till April 2011 to get your money back. So I mean, that's almost 2 years and 3 months, something like that. Anyway, so drawdown is your top to bottom. And so basically October, I think it was October 10th, 2007 to March 9th of 2009. I mean, look at that, 46% in the target fund and only 32% in Wellington. Tough to beat that. And yet Wellington smoked it 7.76 versus 6.17. So 100,000 invested in Wellington's worth 264 with less risk than the target. Now, the drawback about that, frankly, is the target has international bonds and international stocks, and international stocks have just done nothing. Let's see if you're taking income off. Withdraw. Yeah, there we go. Okay, good. So we're going to take 5,000 a year out, or 5%, and adjust for inflation out. Let's see what this does. It gets even uglier. So Wellington is worth 128 after with that 13, 14 years, and the target is worth 90. So that's just, of course, that is a pretty bad time to start 2007. But I mean, the numbers are the numbers, man. The international stuff hurts you for sure. I guess I wonder what would Vanguard? I tell you what, let's try something else. So let's do a Vanguard. Was it European Pacific? Euro? Yeah, European. Isn't it European Pacific? And let's just do this guy. I thought it was a European Pacific one. Yeah, let's just do this. Go Wellington, and we're going to go back as far as we're going to go to 1990. And we're going to go to 1990 to 2000. All right. Right there. Okay. Shoot. I was hoping we'd go back. I thought the Vanguard had a Europe. I'm not going to do it. But anyway, Didn't Vanguard have a European? Hold on just a second. Because the 90s, the international stocks did much better. Vanguard, Euro, European, Pacific. I can't remember. All right. Well, anyway, I just I'm not a fan necessarily of the target funds. Generally speaking, the only reason I'm not isn't because they're bad or good or anything. It's just and they're diversified without question, heavily diversified. So you have a little bit of everything. I don't think they're bad. I just like Wellington. I mean, maybe it's because I put all my study and research into Wellington. I like it, but if I'm going a more conservative portfolio, I'm going to Wellington and Wellesley. And it's just that simple. And there's no real science behind that. I guess, the data would be that I did a book on Wellington. I just like it. No other way around it. All right, let's keep going here. But the minute the international stuff takes off, Wellington will look like a crappy, and the other funds will take off. All right, here we got. What's this guy's name? Whopper. All right. All right. So he says, would a PE ratio of 4 back in the 60s and 70s be equivalent to a PE ratio of 4 now? Or would you have to adjust for inflation where a PE ratio of the 4 would be equivalent to 15 today? All right. No, nothing. The inflation has nothing to do with it. The PE ratio you have to do with is what you could get in other investments, bonds. So a PE ratio of 4 in the 60s and 70s would actually be really in the late 70s to early 80s. A PE ratio of 4, when you can turn around and get a comparable bond at 10, 12, 15%, is a hell of a lot different than a PE ratio of 4 when you have a bond yields of 1, if that makes sense. The inflation has nothing to do with that. It's the interest rates. I mean, literally, you think about it. Always got to look at the risk-free investment scenario. Risk-free is treasury bonds. Some people say short-term treasuries. It could be any treasury, in my opinion. Risk-free. You're not going bankrupt from these bonds. They won't go kaput. The longer-term bonds have more volatility, I grant you, but as long as you hold them, you're not losing your money. You're just not, because that's the risk-free in nature of buying U.S. government debt, to include Ginnie Mae. And so if I can have let's just say I got a stock that pays me 2%, right? And it's got a price to earnings ratio of 25, and I have a bond that pays me 4%, and I'm only locking up my money for 10 years. We'll just use that for an example. I'm getting twice the yield on the bond as I'm getting on the dividend, because it has a dividend, 2% dividend. All right. Now the stock has a PE ratio of 25, which is historically pretty high. So I'm paying a pretty high premium for a stock that has a lower yield than I could get in a treasury. Now, talk about tax rates on dividends versus tax rates on interest. Well, back in those days, you didn't have that much difference. So regardless of the tax rate, just a scenario here, because we'll assume it's an IRA. That bond looks pretty attractive relative to that stock. The stock is priced expensively, and I'm only getting a 2% dividend yield. The bond is just guaranteed. I'm only locking up my money for 10 years, and I'm getting 4%. Now, I grant you, bonds don't compound. Bonds don't compound. Everybody now, bonds don't compound. You said bonds don't compound. I say it. Bonds don't compound. All right, bonds they just pay you. That's it. And you reinvest that interest into something, but it won't be that specific bond you own. It's impossible to you to reinvest in that bond. So bonds don't compound, where that stock does, I grant you. So the stock's dividend yield, in theory, could compound, but it can also go downwards as well. So what happens here is you got a stock that's expensive with a low yield relative to a bond that's guaranteed, that's paying more. All right, now you fast forward and you say, okay, that same bond, we'll even use the same stock, 25 PE, with a 2% dividend. Now that same bond is 1%, a 10-year bond, 1%. It's the exact same bond, except it only pays 1%. And inherently, that stock looks a little bit more attractive. And as such, you say, well, 25 is pretty high, but when the interest rates are 4%, but it's not that high when interest rates are 1%, and I'm actually getting twice the income from the dividend off that stock as I was getting off that bond. And that's what you got to compare it to. They call it, actually what they call is a reverse yield. So let's say take $1 divided by the yield. I don't have my calculator here. I don't want to get into that right now, but basically that's how they kind of look at it. the price to earnings is called the earnings yield of bonds. You divide the yield by a dollar, or a dollar by the yield, whatever it is, and you get, that would be your earnings yield. And you look at that relative to the PE ratio. So in this case, it's a good question, but no, not inflation has nothing to do with that at all. And then he says, a friend brought up a good point. The earnings would be based off the dollar as well as the stock price. Therefore, they'd be pretty consistent, meaning a 4 then would be 4 now. Yes, that's 100% right. Exactly. Yep, 100%. So good question. I like those kind of questions. All right, so we got Ricky. Using a Roth IRA to pay a mortgage balance in retirement. Okay. He's just saying maybe a good subject to explore, using a Roth IRA to pay a mortgage balance in retirement. I suppose, I don't know. I'm not so sure about that. The way I look at the Roth IRA, without knowing whether I don't want to entertain that too much, because we don't know what other assets there are. We just too many other things. Remember, the point about doing post-tax investments into Roth is to get it to grow tax-free for many, many years, to going back to compounding. We want that to compound for many, many moons on itself tax-free. So if I did a Roth conversion, say 6 years ago, and now I'm using that money to pay off my mortgage, that I don't get that, because I literally paid the taxes 6 years ago, and the opportunity cost of having paid that taxes has only a chance to grow for 6 years. So I might be back to even. That doesn't make sense to me. Now, I don't know what the look at that. Ooh, evil. I'm like Bon Scott. I'm on a highway to hell. I'll get demonetized for that because I sound like Bon Scott. Anyway, so what? It depends. There's so many things going on with that. I need more. I get nervous about using the Roth for much, because the point of the Roth is to get the grow tax free for many, many years, to compound on itself. And the second point about the Roth is, frankly, to get the IRA reduced so you don't leave your spouse with a huge tax bomb, or your kids with a huge tax bomb. Talked to a guy today, a couple, and their Medicare premiums, because they've just done well for themselves. No pension, by the way. Their Medicare premiums are going to be through the roof, man, simply because they have a lot of money in deferred accounts. And we're talking, I think when they're 73 or 74, right when RMDs kick in, is 74. That's what it was, because when RMD is 2 years, a 2-year look back. So when RMDs kick in, that's going to put them huge. I think their Medicare premium was like doubling or even tripling. And Right Capital Software shows that to you. It's crazy. So we just started talking about Roth conversions and stuff like this. And, we did the bucket where I say, look, if you were to convert, I think they're off the top of my head, 61, 62, something like that. I said, if you were to convert to the 24% tax bracket, by the time you're 77, you owe no tax. There's never taxes again. You got no taxes. It's all gone, all gone. And you're going to pay half the amount of taxes than you would if you did no conversions. So basically, you do some major conversions in essentially the next 10 years, if you're going to have no taxes ever again once you're in your mid-70s. And you'll pay, in this case, 1.8 million in taxes, where the other case is like 3.6, something like that. And on top of that, they were going to save another $250,000 on Medicare premiums as well. So when all is said and done, they're going to save like $2 million in fees and taxes. And then on top of that, what their kids inherit, because their kids are going to inherit big fat Roth IRAs as opposed to tax deferred accounts. So I mean, it's a slam dunk. Other than the fact that they're going to pay some serious taxes on the front end of retirement. We're talking $200,000-$300,000. Now they're making good money, but they're not super high income. I mean, they're making less than 200,000, I think, something like that. So they're paying taxes. Don't get me wrong, but it's not like they're making, they're not freaking Melvin Capital making 300 million. So they're paying taxes, they're paying FICA and all that. But go from 50,000 a year in taxes, whatever it was, to $300,000. I can't recommend that, man. That's just a bridge too far. Now, if we went to the 22% tax bracket, is better. Reduce their taxes by $1 million, but not 1.8 million, and it reduced their Medicare premiums by 150,000, 50,000. I can't remember, but anyway, if they went to the 22% tax bracket as opposed to 24, as opposed to not doing any Roth conversions, it did reduce their taxes significantly too. But the issue again was, they weren't paying $300,000 in taxes for 10 years. Instead, they're paying $75,000 in taxes, basically for the next 15, 20 years. And if they don't do any Roth conversions, they're only paying like $3,000 in the first couple of years because they don't have a pension. And I'm like, I've been telling you, man, it's easy on paper to say, just go ahead and bite the bullet. But man alive, it's when you see I'm only paying $3,000 or $4,000 for the first 5 or 6 years until Social Security kicks in. And then I'm paying significant taxes. On the counter, I could pay $75,000 my first, right out of the gate, or $300,000. That's tough, man. All right. Ricky says, so many people talk about delaying Social Security to 67 and 70. Help me understand, if I take it at 62, it takes approximately 77 to recover the monies you receive by starting at 62. You really don't catch up and really get the higher income until then. Then why wait? Even though the life expectancy is 85, 87, depending, that's the last 10 years of life. Do we really care or need to be enjoying it at 62? All right. That's a good question. Now all right. So he says similar things to friends and family. Is just a 55-year-old young IT exec and real estate investor. All right. So basically what's happening here is, now I get that a lot. You're saying, look, man, all right. So I get more money when I'm 80, but I'm 80, I'm not, I'm just sitting around, playing shuffleboard. I'm older. I'm just as old as Sniffy Joe. Obviously, Sniffy Joe doesn't know who literally, can we admit that Sniffy Joe has no idea what's going on? He's Weekend at Bernie's, man. It's Weekend at Sniffy's. That's what. Oh, someone should do a movie. Weekend at Sniffy's, and we have like the communists showing up. You know what I'm saying? Like those two guys who are holding up, Bernie. We have like Hugo Chavez and Fidel Castro, the ghosts of the communists, holding up Joe Biden. And like whispering in his ear and say, Joe Biden, say you're going to go after gun control. Joe Biden, say, what's that? No more Title IX. What else do we say? What else would the commies say? Oh, Joe Biden, say you're going to mandate masks, not just one, but 2 masks. No fracking. Oh, Joe Biden, no DAPL, the pipeline. That'll be good because people will think that's environmentally conscious. Even smart people. Professors of biology will say that's environmentally conscious. We won't have a pipeline. Yes, I know we still have to truck all that oil on trains that Warren Buffett gets $6 for every freaking, where it could cost $1. We did the pipeline. Yes, I know it's over the land now, over road on trucks and everything and trains. But hey, we can pretend it's good for the environment, just like commies. Oh, that'd be great. Man, Weekend at Sniffy's. Some of you guys, there's a guy out there or a lady right now who's a budding film producer. That's your thing. And you got Chavez in one ear, the death of the commies right there, whispering sweet nothings to Sniffy Joe. And Joe's like, yeah, come on, man. Come on, man. I'll punch him in the face, man. Come on, fat. They want to rub my hairs on my legs. Come on. I got no respect for Sniffy. None whatsoever. That guy's a clown, 100% clown. As much as I hate to say, he rode Obama's coattails. I don't think he did, frankly. Trust me, I don't think Sniffy Joe did. I think, let's just put it this way. It would have been nice. It would have been nice if we had some assurance that everything was on the up and up. I don't think it was. And as such, but even if he did win, it was all on the Obama coattails, which boggles my mind. I still think Michelle would have ran. I was surprised. I thought for sure Michelle would have came in there. I thought she would have. I guess she likes living large on that climate, the Martha's Vineyard property that's 14 feet off the shore, because they're all worried about climate change and the ice caps melting. And yet they bought a $5 million mansion on the shore. Okay. All right. So anyway, I want to reiterate why, all right, so why you want to first of all, there's lots of 80-year-old people that are kicking butt taking names, man. I know for a 55-year-old guy who's in IT right now, he thinks when he's 50, there's not life. When he's 80, there won't be any life left living. Dude, there's tons of people. I talk to people every single day. I have 2 or 3 appointments a day. All right. And I talk probably 2, sometimes 3, sometimes 1. I average about 2 appointments a day. And I've been doing this for many, many, many years. I talk to tons and tons and tons and tons of people of all shapes and sizes, all over the country. Hell, some in Mexico, some in UAE, one's in, was it Singapore or Malaysia? I forgot. But anyway, all over the place. And I'm just telling you right now, 80 is not, it's not Sniffy Joe. There's a lot of people out there 80 years old that are freaking Sprite and probably kick our butts without question. Anyway, so you gotta consider that. You're not just sitting around like, looking like Sniffy Joe. You're not. You actually have some. Let me just make sure. Okay, you actually have some. A lot of people actually at 80 still have a lot of energy and a lot of living yet to do. But part 2 of this, remember, when they did the Social Security, the Reagan bill in 1983, where they raised taxes on it for the first time, but they also gave the delayed earnings credits and whatnot. So what happened was 8% delayed earnings credits, all right, is basically 7.5% every year you wait. So look at it like this. You got 2 different scenarios. Is that me? Oh, thanks, babe. You're the best. All right. Raise a glass to Sniffy. Oh, look, South Dakota is my South Dakota mug right there. For the record, I'm not all that convinced that Chrissy Gnome yet either. I want to see more about her before I throw my hat in the ring for her. I'm just not convinced, so we shall see. But anyway, excuse me. So when they pass, so remember, your full retirement age is 67 for most of us. All right, so that's my full retirement age. All right, so if I take it at 62, it's reduced by basically 7.5% each year under the age of 67. If I take it at 70, it's increased by 8% each year until I'm 70. So if I take it at 62, inherently, I'm losing 7.5% a year, if that makes sense. All right. Now, put this in the context of when they designed the bill or the law that to govern Social Security. The law that governs Social Security was designed in 1983. What were treasuries doing back then? Well, hell, I mean, 1980, you could have bought a 30-year treasury bond for 15 and a quarter in 1982. That didn't mature until 2011. The shorter term treasuries were paying more. So we'll assume, off the top of my head, I don't remember. We'll assume a 10-year treasury is paying, we'll just say 15%, just for simplicity. When they signed that bill into law, Reagan did, 8% delayed earnings credits, that seemed like nothing. And if you look at old insurance contracts, they're like, we'll give you a guaranteed minimum of 4.5% on your cash. Everyone's like, 4.5%, that's nothing. And now people would kill for those guarantees. All right, so we fast forward to, 40 years to today. All right, interest rates on the 10-year treasury is 1%, whereas interest rates used to be 14, 15. But you're still getting the same delays that you used to get with the credits. The longer you, it's either 7.5 or 8, depending on if you take it before your full retirement age or after. And you're not getting anywhere near that in interest rates. You're just not, man. And so from a pure investment perspective, you're getting a 7.5 to 8% guaranteed rate of return on an account, by the way, that at max 85% is taxable. That's it. You know for a fact 15% will be tax-free. That's just factually correct. So 3 things going on, 4 things going on. I'm getting a 7.5 to 8% guaranteed rate of return on my money. There's a cost of living adjustment, compounding, by the way. 85% at most is subject to taxation, and it's 100% the safest investment there is. Now, counter that to taking at 62 and instead letting my portfolio grow. All right, well, my portfolio has no guarantees. If it has a guarantee, you're not getting 7.5 to 8% guarantee. You may or may not get compounding because it depends on what the market does. I mean, you could go compounding it could go south too now, right? Because if you're trying to get 7.5 to 8% rates of return, you're going to be in stocks. Stocks are not guaranteed. They're just not. They don't come with cost of living adjustments. They just don't. Everyone says stocks are a hedge against inflation. Not necessarily. I mean, they could be, but they might not be. They weren't in the 1970s. That's for damn sure. So you have all the risk. You're getting a less potential rate of return. We don't know, but I still use the Vanguard models, and I'm very comfortable with that. So if I have a 6% stock projected rate of return, all right, which includes 2% dividends, because remember, Vanguard, John Bogle, and most people will say, how do you project your stock returns? earnings growth year over year plus dividend yield. Is that it? Earnings growth year over year plus dividend yield. So 2% dividend yield, 5% earnings growth year over year, that's 7%. Sometimes I'll get 9 because of price appreciation, i.e., PE ratio increases. That's just people are more eager to buy the stock. Sometimes I'll get instead of 7, sometimes I'll get 5 because of price depreciation. People less eager to buy the stock, and that's fleeting, and that's just people's the way they look at the market. So some people bid up like GameStop, some people bid down like I don't know, whatever, GameStop, whatever it is. I don't know what happened today. I really pay no mind. Anyway, so what happens is we know we're going to get, Vanguard says about 6% on stocks for the next 10 years. So I'm like, all right, 6% on stocks, very aggressive, very risky, no guarantees. I might get more, I might get less, I might lose money. Versus 7.5 to 8% on my Social Security, which has a guaranteed cost of living, 100% guaranteed by the federal government. Only 85% at most is taxable. And it just seems to me that's a slam dunk, in my opinion. So you can walk around like Sniffy Joe when you're in your 80s with higher Social Security and lower stock returns. That just seems to make sense to me because the stocks you sold while you're waiting to take Social Security. Hope that makes sense. I'm going to hit this a little bit harder in future videos because I do think people are way underestimating and valuing the benefits of Social Security. And I don't think they should. All right, we got Lenny. All right. Ooh, Lenny. Let's see here. What if I just want to take Social Security? Here we go. Social Security early to invest the money at 62. Since I have other investments and don't need that money to live off. And I get a 6% or better return on investment for the 5 years that I've taken at 67. Is it worth taking out early, investing it, or am I better off in waiting to my retirement age? Well, I think we just answered that. I just, again, I mean, I think at the end of the day, if you think you can get 10, I would look at like 10% because you got to factor in the guaranteed nature of Social Security where your investments do not. And you got to factor in the fact that your Social Security is taxed more efficiently than your investments. If you think you can get 10, yes, I would take Social Security early if you think. Maybe I'm just too conservative. No way I'm doing that, man. And no way am I assuming a 10% rate of return. No way. But some people do. If some people do and they tell us, I say, why do you think that? And they go, well, historically, I want to put this not on my head. And I wanted to have an anvil and just go like this and have an anvil fall on my head. I want Dr. Fauci to come here and wrap my head with my hat on with 50 surgical masks and then put saran wrap around my nose so I can't breathe out my nostrils. And I want Dr. Fauci to sing to me Pink Floyd. That would be a suitable torture for me, if that makes sense. Because the historical rates of return, we can slice and dice that any which way we want. Historical what? The last 10 years, last 20 years, what? 1926, why? I mean, I've gone through this a million times, and I'm not mad at my man Lenny here. I'm just saying the historical rates of return are a big fat nothing burger when it comes to projecting future rates of return. I mean, you could use that as a starting point, I suppose, but then you say, why 1926? Why not 1871? Why not 1972? Why not 2000? I mean, all these different things. It's, there's no more Bethlehem steel, but there is Amazon. So how do you see what I'm saying? It's just, I don't like the historical rates of return. All right. Scott says the best ETF to invest in a taxable account. That's his question. VTI. Easy. I will dark. He says VIT. No, VTI. I don't know what VIT is, but VTI is the dividend yield worth the extra. Okay, so he. Okay, yeah. So he thought I said VIT. I don't even know what VIT is. So VTI is the best ETF to invest in a taxable account. All right, we got Richard. A friend of mine told me about two funds that have dividend payouts of 20%, CLM and CRF. What do you think of these two funds? Oh boy. Well, let's take a gander at these together. So let's. I can already tell you, I'm not not liking them. Oops, hold on, just a second. Let me get out of that. Let me open up a new window. All right, so let's take a gander at these together. So let's. I'm not going to be. I'm not liking them. Oops, hold on just a second. Let me get out of that. Let me open up a new window. All right, so let's take a gander at these together. So let's. I'm not going to be. I'm not liking them. Let me open up a new window. You made me feel like dancing. Gonna dance the night away. You made me feel like dancing. Don't care what you say. All right, so we're going to. Oh, by the way, the whole thing with silver was a big fake. The Reddit guys weren't saying to buy silver. It's all freaking Wall Street. It's all freaking Citadel people saying buy silver, because they had so much money in silver. They're trying to get back their money. If the media says it, you got to assume it's false. It's fake news, man. If the media says it, you've got to consider it fake news. Every single thing the media says is fake. I cannot stand the media. All right, so let's go to CLM. I've never heard of this or known anything about it. Cornerstone Strategic Value Fund. All right, so again, if it's got a 3 ticker symbol, that means it trades on the New York Stock Exchange. Most likely. There are some ASE stocks that trade 3 tickers. But generally, it's a blue chip, if that makes sense. So it's got 3 tickers. That means it's a blue chip stock on the stock exchange. And ETFs are also traded on the stock exchange, as witnessed by this guy right here. NASDAQ usually has 4 or 5 tickers, letters in their tickers. Mutual funds typically have 5 as well. So just in the back of your mind, AMZN, that's Amazon, that trades on the NASDAQ. Freaking T, that's AT&T, that trades on New York Stock Exchange, just as an FYI. All right, so let's go here to see what's going on with old Cornerstone Strategic Value Fund. I can almost guarantee you it's not paying a 20% payout now. I assume he means dividend yield, but let's take a look here. And I don't know the first thing about it. Right there, well, 14.95. So that means the price has probably gone up a little bit since he had written me back in October. So let's take a gander. We just look at the 6 months. Yeah, so in October when he had written me, the price was $10.95. Now it's up 30%, 20% or so. So that would make sense. Price goes up 20%. Dividend yield goes down because I'm sure they haven't changed their dividend, the actual dividend they're paying. Yeah, I don't. Let's take a look. I wonder if they got to be leveraged to the hill or something. I just don't know. Let's go to when did this thing come to be? All right, so here we go. So all right. All right, so what is it telling you right here, my friends? Can you all see this? Yeah, I'm sharing it. All right, forget this right here for just a second. So we're at 46, 42, 30. Let's keep going. 35, 30, 26. You see a pattern here: 14, 16, 15, 12, 11, 10, and back to 13. I don't know what this payout consists of. It just seems to me is eating into his principal. As such, basically what's happening here, the principal is dying. And as long as the principal dies, the yield will continue to go up, but that means you're losing the price. So yes, you're getting a nice dividend yield, but as long as like an annuity at this stage, you're getting a dividend yield, but you're losing share price. And I would imagine that to be the same thing. You can't find, anytime you see, if it's too good to be true, my friends, it is. 15% dividend yield, that tells you only one thing and one thing only. Two things, I should say. Either they had a special payout, which it looks like they did not have, or the price is getting hammered. And the price, as you can see, has just gotten, look at that. I wouldn't touch that with a 10-foot pole. Because you can pretty much make a safe assumption that's eaten away into his principal to pay you your money. Or they're raising, they're not even, I don't know how, I wonder what, I'm not sure these guys have debt. I don't know how it works. I just, hey, dump your cash now, says Peter Stansbury, or Porter. Is that his name, Porter? Send it to me. Dump your cash, send it to me. Cornerstone Fund announces continuing monthly distributions and reset distributions for 2021. I'm not touching a 10-foot pole. All right, so let's look at what this other guy is. CRF. I imagine that's another Cornerstone. Yeah, Cornerstone Total Return Fund. And let's see right now. He said this was paying out over 20%, and now it's paying the same thing. So 14%. I bet it's going to be the same. Yeah. Let's see. We just go 6 months. Back in October, right here is trading about 10. Yes, it's almost identical. So it's gone up 20% or so. Yield goes down because the price has gone up. They're paying $1.84 dividend. But you're essentially getting your money back. I bet we're going to see the same thing here. Yeah, it's that exact same scenario, man. I don't know what I mean, look at that, just progressively going down. I wouldn't touch a 10-foot pole. I have no idea what is going on here. I wouldn't touch it. Again, people get too, remember dividends. Dividends in themselves are okay, but if you're not reinvesting, I don't know. I just think people get way caught up in the dividend train. Dividends, you should reinvest. If you're not reinvesting the dividends, well, you got the cash and you got a declining price. You got a declining asset. It's like a car. You're basically, the car is paying you a dividend, but it's losing its value each and every time you turn on the ignition. Same things happen with these things. And so, yeah, you got cash, but the cash isn't being reinvested. It's not being, and if it is being reinvested, well, hell's bells for you here, because you're reinvesting in your car. No one does that because it's a declining asset. Don't do that. I mean, you want things to grow. That's what we want. We want things to grow. So I'd much, much, much rather have a 3% dividend yield on, I don't know, S&P 500 index, right? Because if I would have bought that at the same time that these guys came out in 2004, well, I'm only getting a 3% dividend yield. My actual dollar is, I wonder if I can do that real quick. I think I might be able to. Let's go to, I think I can, political calculations. Yeah, let's try this. Hold on just a second. I'll share my screen with you. If I can find it. Yeah, my man Angelo says, look at the payout ratio, 100%, brother. Let me get my screen. That right on. Look at the payout ratio. Absolutely. Actually, I wonder what. All right, so here's political calculations. S&P 500 at your fingertips. All right, so let's just go to let's say 2004 compared to now. It should give us it gives a dividends. All right, so we'll say 2004. All right. Right there. All right, so let's go to 2004, calculate. All right, so right here we had $17 of dividends, all right, in 2004, and we've increased our dividends by 300% over that time frame. Now, people get all their tighty-whities all up in arms here when I say, so if I would have bought $100,000 of S&P 500 back in 2004, all right, what is my yield today? Now, it's a yield of cost. I don't get semantics in my opinion. I'm getting $58 on that $100,000 I invested per share, if that makes sense. I'm getting $58 per share. I was getting 17. All right. So if you want to do that quick calculation, you can. But at the end of the day, I've increased my dividends by 300%. 300%. On top of that, I've also happened to increase my price as well by 300%, a little bit more than that, maybe 350%. So the point about dividends is that it's okay to start with a lower amount as long as the thing that you're buying you think progressively can grow. The dividend payouts grow. All right. So you can see right here, $49 $17 to $58. Back then, the yield was 1.55. Now it's still 1.53. It's actually gone down. Doesn't matter. Why? Because I've increased two things. I've increased my price by over three times. I've increased my yield, my dividend, my actual payout, not my yield, my payout by 3 times as well. Much, much more valuable in here than that other crap thing there, because I lost a significant portion of my capital, even if I'm getting a big fat dividend payout. Who cares? But yeah, my man, he said, let's look at this real quick. He did say look at payout ratio. Let's see if we can find that. That's actually a good point. I can't remember where the payout ratio is here. Finance, I don't think it's there. Is the statistics. All right, so payout ratio is how much of their profit they're paying out in dividends. Revenue growth. In this day, I just whoa, what the hell is that? 4,000. What? $4,000 in cash? Uh-oh, share short, 915,000. Go Reddit people. How $4,000? Dividend yield payout ratio. Anybody see right there? Oh, what? 400% payout ratio? What? I mean, I don't even know how you can do that unless you're. I mean, are they got what? Well, they made 80. They made $8 million. A 400% payout ratio. Damn, I don't get it, man. That doesn't make any sense to me at all. Profit margin. They must be. Are they leveraged? I don't know. I don't know what's going on here. That doesn't make any sense to me at all, man. Let's just look at financials. Yeah, I don't know. That doesn't make any sense to me at all. I'm not sure what's going on. Anyway, I'm not touching that with a 10-foot pole. No way. So anyway, yeah. So payout ratio is the again. If you guys, I saw something about cash. If you guys don't like your cash, send it to me. I'll put it to good use for sure. All right, let's see what else we got here. Me amigos. We got Lily. All right, Lily. And Lily says, all right, I'm really intrigued by those Roth conversion related ones. Videos. I have rollover IRA from a previous employer that's been sitting there for a few years. I wonder if I can convert to a Roth while still working and maximize my yearly limit. Currently 49 old and plan to retire in 10 years. Can he, well, yeah, can he convert while still, I guess he's thinking, or she is thinking that he or she might go above the contribution limits of the Roth, like was it $200,000 or something like that? I guess that'd be the only thing that she's thinking about. I don't know, and yeah, you can certainly convert, and as long as you stay below the thresholds, you can definitely continue to contribute. Yeah, you can. Okay. All right. Let's keep going here. Who's this right here? This is Bill. Bill, I'm 62. His better half is 60. We both work for the same small company, and each of us contributes the max to our simple IRA. Currently, my balance is over 500, and her balance is almost 200. Our income is above the limit to contribute to the Roth. There we go. Last month, we made a backdoor Roth contribution. We opened up 2 new traditional IRAs at Fidelity, deposited $7,000 each, and then converted to a Roth. Okay. Yes, I learned that I was getting ready to say this could be bad. Yesterday, I learned that the pro rata rule must include the balances of your simple IRA. Yep, I was getting ready to say this could be bad. So when filing IRS Form 8606, it looks like the $14,000 we converted to the Roth will now be taxed. Well, is that true? That is now taxable. Can the conversion be undone? All right, so that's where you want to talk to a tax guy. He's got a bunch of different numbers here that don't mesh to me, but at the end of the day, the simple IRA is part of the pro rata. The SEP IRA is as well. So if you have IRA balances, pre-tax IRA balances, you can't. There's no such thing as a real backdoor Roth. You can't do it because of pro rata amounts. But he's saying essentially the amount that he converted will be taxed. Well, I'm confused. The whole point about the backdoor Roth is to go to a non-deductible and then put in a Roth. I mean, that you're paying the tax to do that. So I'm confused. Anyway, you got to know the pro rata rules, man. A simple IRA means that you have pre-tax IRAs, simple and traditional IRA. You can't just do a backdoor Roth when you have pre-tax IRAs. You can't. This would be, you'd want to chat with a tax guy for sure. He says, can it be undone? It used to be able to. You used to have recharacterizations. I don't think you can do that anymore. used to be able to recharacterize, which is freaking awesome, by the way. I don't know if you can do that anymore. I remember the Trump tax bill. That's one of the negatives of the Trump tax bills. They got rid of the recharacterization. But you used to be able to tell the IRS up until the tax filing of the following year that you wanted to recharacterize Roth conversion, which was awesome because what you could do, what's up, girl? What you could do is you could basically say, I'm going to convert to 5 different ETFs, international, small cap, large cap, gold, and you name it. And whatever did poorly, you'd recharacterize to your traditional IRA. Whatever did great, you just leave. It was freaking awesome. It was called, but it'd have to be an individual Roth IRA accounts to avoid the anti-cherry picking rules of the IRS. It was sweet, man. You should really read some tax folks who are into this stuff because they really get the nitty gritty of the tax code. They say, you can do this. And then because when they pass these tax laws, the freaking congressmen don't know what the hell they're doing. They're just doing what the lobbyists tell them to do. And then it's up to the IRS to manage it, to make sure that we all follow the letter of the law, essentially. Well, the IRS misses stuff all the time, too. So you got some enterprising tax attorney who goes, let's do this, let's do that, let's do the back door, let's do the next thing you know, a couple years goes by, the IRS says, nah, that's not what we intended. It's kind of funny, actually. It's kind of like the old file and suspend. That was never the intention of the Social Security rules. My man Don says he's married. He got $1 million as traditional 401k. New owners just switched me to a new position. Salary doubled. Should I switch to Roth 401k now on new contributions next year? Salary doubled. And his salary doubled to a pretty good amount too. Yeah, I don't know. See, that's the thing. I don't know if he's got pension. He's 62, so he's I see where he's going with this. He's saying, look, in 10 years, I'm gonna have a pretty significant RMD. I don't know. That's a tough one right there. I don't know what other income he has. I don't know anything about that. If that were me, I probably would. Like right now, I don't do any pre-tax stuff, even though I'm making pretty good money. I hate the idea of having a lien on my property called the IRS. I hate it. I'm willing to pay more money today to avoid those liens in the future. I'm telling you, there's nothing worse than just listen to me. When I did 2018 and I had no money, I had to take $100,000 under my IRA, my 401k/IRA to fund this business. I had to pay a 10% penalty, and I had to pay ultimately, I think it was like $30,000 in tax on the $100,000 distribution. I hated it, man. It was the biggest. I hated it more. I can't even explain how much it bothered me. I said I would rather have had paid a little bit more in tax each and every year while I was building my 401k than that big one lump sum, if that makes sense. Oh, that was painful. I said I'm never doing that again. And so I would rather pay, death by 1,000 cuts from the tax man. I'd rather be sliced and diced a couple extra $1,000 a year while I got the money coming in to afford it. So that way, when I don't have the money, when I retire or YouTube bans me and, you guys all turn on me because you know how much I love Tom Brady, that if I need money for my accounts, I don't get hit with a tax on top of a penalty. And don't forget, I had no money anyway. In 2018, we had none. I quit my crappy old job. I was making over $200,000 a year. I had no income. You see what I'm saying? I still got 4 kids. That's pre-dogs, but still had 4 kids, no income, big fat mortgage. And I was like, I got no income. Well, it doesn't matter. If you're pulling $100,000 out of your IRA, you're pre-59.5. The IRS doesn't say, hey, it's cool, no worries. No, they still say pay up. So what was a $100,000 distribution actually cost me $130,000. All because of Chloe right there. Oh, Chloe. I'll just do a couple more here. This is Charles. Can I ask you what you can do about our traditional IRA? My wife had to take all the amount of $165 from her job. They changed hands and went to the bank and put it in mutual funds, all right, through Fidelity, which was done by an advisor in the bank because we had no clue what to do. We have yet to pay the taxes on it. I'm wanting to close it down and be our own money planner. What would you say is the wisest approach? I'm 67 and my wife is 64. I'm collecting Social Security, and the work online is I have a collector sports business, but never made a lot of money. I'm a nutritionist in blood therapy, but I'm not sure. I'm not informed on taxes and investments, and I really need you to advise so we do not overpay on taxes. All right. Stay safe, Josh. All right. So, I mean, yeah, if you just roll that to your own IRA at Vanguard, I just like Schwab. I mean, there's no other way around that. Actually, someone emailed me today, a good client, some nicest people in the world. They said Vanguard was rude to him, man. Vanguard was rude. And I was like, dude, what the hell? So they're going to Schwab, which I like. I'm not, that might not be indicative of the whole company at Vanguard. They just seem to be bursting at the seams. I'm getting that impression. Anyway, they seem to be bursting at the seams. Where I don't know. I just like Schwab, so he could roll. Just move his money, a trustee to trustee transfer into Schwab, easy as pie. It's not a taxable event as long as it doesn't cross your hands. Frankly, even if you get the check, as long as you redeposit that within 60 days, Charles, it's not a taxable event to you. But we don't want that to happen. So you call Schwab, you say, hey, this is Chuck. Chuck, get it? Chuck Schwab. Hey, this is Chuck. Hey, Mr. Schwab. Oh, you know what you really should do? You say, hey, this is David Pottruck. I need to open an account. David Pottruck was a CEO back in the 90s when I worked there. And I think he got fed to pasture, essentially. I don't know what happened. It seems like his tenure was not very pleasant. It's kind of funny, actually. I just laugh because, that was back in the heyday of the online trading thing. And Charles Schwab wanted to be an investment company. I'm not an investment company, a tech company that happened to do investments. And it's funny, when I went to USA, they wanted to be a tech company that happened to do insurance. I said, what is it with these CEOs and all the corporate people, like all talking the same crap? Does anyone have any sense of individual thinking, man? Oh my goodness. I want to be a tech company that happens to train dogs. You know what I'm saying? It's like, Anyway, so he should just, call Schwab, say, hey, I got $165,000. I want to put it over to a Schwab IRA. That's not a taxable event. How you invest, that's going to you have to think about that. Son, you have to do some research. How much risk you're willing to take, all that stuff. There's no way for me to advise you in that regard. But it'll go over as cash, most likely. It'll sit in a money market account, and then you can kind of dabble. You say, okay, maybe I put $20,000 a month into the market. Maybe I put $10,000 a month into the market. Maybe I put the whole thing. You just got to do some research, and you talk to the people at Schwab, man. I mean, they're not ogres. They're going to say, hey, this is what we recommend. And I actually like the Schwab intelligent portfolios. I do. For folks who are kind of intimidated by the whole thing, and it's okay to be intimidated by it, start with intelligent portfolios. Get comfortable with it. Wait a year, wait 2, and then figure it out. And then you can, freaking rock and roll on your own for sure. All right, just a couple more. We got Silvio. All right, Social Security calculation. I know Social Security uses the highest 35 of earnings to calculate. What happens to projections for 67 or 70 if you stop working at 62? If you continue to work to 67 until the years between, all right. So what he's saying is, if you work from 62 and 67 even until 70, will those years be counted of your top 35? Yes, if they are in your top 35, absolutely. So that will be counted. So if that, what's her name? Elaine Floyd over at Horse's Mouth talks about that, how she works past her 70s and has had some of her earlier years, as I think she was a stay-at-home mom for a few years, drop off, with her earnings in the 70s, even though it gets recalculated because she had goose eggs or small earnings. Now she has more than goose eggs and small earnings. So her older years were dropping off, even though she's well into taking Social Security and is above 70. So yeah, I mean, every year you work, those will be recalculated to they'll be recalculated to give your top 35 for sure. I got a teenage boy up there arguing with my wife, so I have to go lay down the law. All right, here's my man Ted. All right, Teddy Ruxpin. Anybody remember Teddy Ruxpin? All right, just all right. Oof. All right. Okay, so he says, town of Yarmouth, Maine just passed a $52 million bond a year ago to remodel all the schools and build a new municipal building. Of course, we had to build a Cadillac municipal building because neighboring town just said, and we must be better. The bond passed overwhelmingly and is the largest in town history. But get this, the estimated cost of the school renovations and municipal building jumped from 32 to 52 million in just 6 weeks. I went to all the town meetings and got the usual doublespeak from council members and town manager when I asked the reasons for the increase. Here's why. Because Trump put tariffs on Chinese goods and it caused building costs to go up tremendously. So they initially offered the bond at 32 million, but then when it got approved, I went to 52 million because Trump's Chinese tariffs. These folks have even found a way to blame this on Trumpster. The annual town budget is always the same every year, with the school budget getting on average 6 to 8% increase when the municipal budget suffers. There's even one counselor who said the school should get a 10% increase every year in perpetuity. As you point out in your video, only a small percentage of people in town actually vote. It kills me when they're confused as to why their tax bill increases this year. Exactly. I still haven't decided if I think it's voter apathy or just plain stupidity. I'm leaning towards the latter because the budget passes overwhelmingly each year by a 2/3 margin. The way they do is to get all the parents of school-age kids to vote in favor of passage, and it works every year. I'm telling you, man, it's then when their kids are out of the school system, they move out of town because they don't want to pay the taxes anymore. The advocates in favor of passing the school budget argue the same thing every year. It's this. It's for the children. It's for the children. If you don't support them, then you hate kids. I vote them all down. Every single bond I vote down. I hate kids. I have 4. You hate kids. You hate public schools. I have 4 kids in public schools. Oh, well, you hate teachers' unions. That's what it is. I had a guy on here saying, why are you so angry towards teachers? I'm not angry towards teachers. I'm angry towards teachers' unions. They're probably the biggest roadblock in favor of fixing what's wrong with our country. The NEA and the AFT, man, these guys are just bad news, man. If you have a non-union shop and NEA comes around, National Education Association, man, you should run for the hills, dudes. I'm just telling you. Why is the NEA commenting on all kinds of political stuff that has nothing to do with teaching? Well, because they're not a teachers union. They're a left-wing political organization whose only job is to get Democrats to do their bidding. That's just a fact, man. Yeah, right. There's also a rule in the town charter that indicates anyone employed by the town cannot be on council. Pretty reasonable since there is an obvious conflict of interest in doing so. Well, now a high school teacher was recently elected to council. Yeah, right. We know how that's going to be. High school teacher recently elected to council. What do you think she's going to do for the school budget? Take a wild guess. All right. This guy is in Maine. So anyway, it's just kind of funny. Yeah, so I just said to him, I said, well, who's getting the extra $20 million? I mean, someone is. They offered the bond at 32 million. It came in at 52 million. There's an extra $20 million that changed. Who's getting it? I can guarantee you it's not because of Trump tariffs. Because it's this whole point, man. You got to get involved in your local elections. You got to. Just reading and watching and seeing who the Maroons are, who are in charge of the lockdowns. These aren't the brightest freaking bulbs, man. I did a video where I was talking about this lady up in Worcester, Massachusetts, or the town right north of, like the 5th largest school district in Worcester, Massachusetts. She literally is like an insurance collector for the hospital. She's not a nurse, nothing like that. She's an insurance collector. And she is literally the quote expert on there's like 5 districts up there, her school district, of which is like the 5th largest in all of Massachusetts. Chloe, you want to let him out real quick? Thanks, girl. And she got approved to the public health authority over a real doctor who is specialized in virology. And she's the one making a decision on whether or not kids go back to school. Good times. And how did she get it? Well, because her husband is a fireman and he's a nice guy. Yeah. All right, one more here. Lenny asked, no, that's not Lenny. We already did him, I think. All right. Lawrence, retired 55, 403B in addition to my pension, but I don't really plan to use before the election. I dumped everything to the fixed account. I was just curious what you think I might do the 403B now the election's over and fixed and put it back in one of funds. Nah, I don't know, man. I get a lot of questions like this, and I guess I didn't see that one initially. I can't tell anyone what to do. without, there's just, I mean, there's so much and I'm not, I gave up my licenses many moons ago, but the facts are, for me to say, hey, I think you should invest in the S&P 500. I think you should, I don't know who you are. I don't know your circumstance. I don't know anything about you. I don't know how you reacted in 2000. I don't know how you reacted in 2008. I don't know how you reacted in Q4 2018, Q2 of 2015, Q3 of 2011. Never mind what happened last year. I don't know. And I don't know what your needs are, so there's no way for me to answer that. So let me just do one more here. All right, Roth, here we go. This is from, I'm not sure who it's from. All right, Roth conversions for singles. I recently found you on YouTube and found you helpful. Love your dogs. Well, thank you. I've spoken to a few financial planners who do not agree that I should consider Roth conversions. But I think I have too much tax-deferred savings. I just turned 61. I have one more year before I retire from the federal government. Can't wait. Have a pension, approximately $40,000 a year. Will draw Social Security when I'm 67. I have about $500,000 in my TSP. No, $500,000 in a traditional IRA and $1 million in my TSP. My idea is to roll my start doing partial Roth conversions on the traditional IRA. Yeah, that's a tough one, man. I don't know. That's a tough one. I just, that's one of those things where you got 1.5 million in tax deferred assets. You're going to get 40,000 a year pension. You're still going to get probably another 30,000 a year, if not more, on Social Security. 75,000 a year right there. And you're single, you're already in the 22% tax bracket. I don't know. It's hard for me to see a single person with pensions. What's the benefit going to be, frankly? Now, you might have kids, you might be, divorcee or widow. I don't know. But, it's hard for me to see the benefit of paying a lot of money, because it's usually going to take, 10 to 15 years just to get back to where you were, maybe, depending on the market conditions. And, if you're single and you got a pension, it's not like you're as a low tax bracket to begin with. I'm not the biggest fan. I would need to be convinced that it makes sense to do that for sure. So I'm going to say niet, as my boss Putin says. Say niet. All right, so let's see what kind of questions you got here, mi amigos. Impossible to visit Louisiana and be hungry. Everyone's family offers you good food and gets offended if you don't eat. LSU, oh boy. No, weekend sniffies. Hey, Nanko, the IRS lady. All right. There she is from the IRS. So everybody, shh, we got an IRS person here. Shh. Full scholarships to LSU. That means they got to live in Baton Rouge. Ugh. Yep. Biden administration is definitely going to cause the price of oil to go up. Yep. I got $10 he won't make it his first term. I completely agree. Oh my goodness. Jen Psaki. Oh, it's just, oh. Oh. Jeez. Yep. Kamila is going to take over. Exactly. Will Georgia ever go back to red? Well, we would have, Javier, if they friggin' this is the thing. The Republicans just need a big cleaning out. I'm sorry. You hear this thing with John Weaver and the Lincoln Project, and apparently it's well known among the establishment Republicans that essentially is our version of the Catholic priest. Everybody know we had a bunch of pervs, and it sounds like it's more than just John Weaver. I mean, it sounds like there's a lot going on with a lot of people who are very active politically in politics, the Republican Party, and even ran for president as an anti-Trumpster, if that makes sense. Even supported Biden, and I think even Clinton too. Sounds like a lot of bad people, and they knew bad things were happening, and yet John Weaver was our Republican Party version of Harvey Weinstein. And they didn't do a damn thing about it. Apparently, it's been going on for a long time. And this is the guy who ran McCain's crappy campaign. And Steve Schmidt, I think, ran Romney's crappy campaign. I mean, we just got some bad. And you've ever seen Rick Wilson? That guy's just. Literally, these are not good people. I forget Republican and Democrat, just not good people. These are grown men. it's just weird stuff, man. There's some sickness up there. And I don't want anything to do with it, to be honest with you. I'd rather lose and keep some of my dignity. I'm sure that's what people said about Trump. I'm like, okay, these same people said Trump had no morals. These guys are running around with freaking, Rick Wilson and Steve Schmidt and this guy, John Weaver, and all these other clowns. And they can all kiss my butt. As long as I have any say in the Republican Party, I don't want anything to do with it. I just tell you right now, there's some freaking sick mofos. And it's disgusting. Young man gets out of college. He's trying to get his first job in politics, which I get it. I wish that some of these guys would not look at politics the way they do. But be it as it may, and some guy named John Weaver basically wants them to friggin' casting couch crap. And scumbag. And now he's hiding, well, I'm gay. You weren't. It's just the whole thing. It's just corrupt as can be. It's so corrupt. And yet, the people are paying big bucks to these people. I don't know why. I don't know. It's the weirdest thing. But it's not just those clowns at the Lincoln Project. It's incestuous throughout that thing. The Democrats have their own crap. Look, we know Ted Kennedy was a freaking. Him, Chris Dodd. We know all these people. The Steffi Joe, the Clinton. Freaking, they're scumbags. All of them. And we just need a good cleaning out. Now, I can't control the Democratic Party. Maybe AOC will do it. You know what I'm saying? Maybe she'll get her brand of Red Guard Maoists in there. I don't know. But for the Republicans, this is disgusting. And I don't want to win with these people. That's the thing. I'd rather lose than win with these scumbags. So Georgia could have turned red, except we have the two senators who didn't want to turn it red. And the freaking Puffenbarger who didn't want to turn it red. And freaking Brian Kemp, I don't know what happened to him. I still think he's mad that Trump called him out, and which Trump stupidly did. And I don't even want Trump to run in 2024. I don't. I know Trump is probably a kingmaker, and if he starts a Patriot Party, I'll join it. I just want someone different. You know what I'm saying? Someone doesn't shoot themselves in the foot. And I don't care about the Twitter crap. I care about the fact that you're calling out your Tom Massey. What the hell was that? Saying Tom Massey should leave the Republican Party. You can't do that to your friends, dude. Jeez. There's something called praise in public and criticize in private. And Trump doesn't do that. It's just not good. And I'll never forget when he called Massey out, when he called Brian Kemp. I was like, what are you doing? And then throw that on top of that. In the May of the coronavirus crap, he was getting a spat with Joe Scarborough. Like, yeah. Oh. All right. Cole graduate of University of New Orleans, but I ran around the LSU campus almost every weekend. Maybe I ran back to them. Yeah, I'm sure Cole was the ladies were a little bit nicer at LSU than University of New Orleans. Let's put it that way. Yeah, why wouldn't you want to be energy independent? It's crazy, especially when they say, "Well, we want to make sure we're green." Well, China has ramped up their coal production like crazy, man. So it's like you're not being green. You're just giving the money to China. It's nuts. China's coal production is going through the roof. We know they're having essentially slave labor in Africa. It's just the whole thing is crazy. Yep. Just need a few storms to take out a few refineries. And all of a sudden they'll be begging for freaking fracking. Cuomo. You think Cuomo's done as the AG of New York selling Cuomo up to Rikers? I hope so. I thought that was pretty interesting that the, what's her name? Letitia James. She issued that report saying we always knew Cuomo was a grandma killer, but he was underestimating by thousands. So she wants his job. And I think it sounds like AOC might run against old Chucky Schumer. So I love seeing that kind of stuff, that kind of infighting on the left. I love it. About damn time. And you got these two white guys who, they're supposed to be Schumer and Cuomo, old white guys. And you're going to have, I think, Letitia James, I think she's black, is the AG for New York, and AOC, she's a rich, but she has brown skin. She's a POC, so everyone, POC. And hey, good on them, man. Take out these old crusty white guys. They're all fake news. I like it. Take them out. Got no problem with that at all. I mean, look, New York is never going. I mean, other than Pataki, we're never into Alphonse D'Amato. I mean, those days are long gone. New York will never go back. So I still say the Republicans, if they're smart, and this is where we know the Republicans are not smart. It was Gingrich back when 2000, I can't remember, it was 20-something years ago. He was on board with making Puerto Rico a state because he thought it would appeal to Hispanic voters. I could not. I was sitting there thinking, our side is so, I don't know what it is. They're so friggin' stupid. I almost wonder if they've never actually worked around or suburban white people. That's the only thing I could possibly think, because I'm sitting there thinking, do you really think Mexican Americans in South Texas or Phoenix or California give two craps if they're going to say, oh, Newt Gingrich wants to make Puerto Rico a state. Let's vote for the Republicans. It's just the whole thing's insane. It's crazy. And I'll never forget that. And then, of course, a couple of years later, he's sitting on the bench with Nancy Pelosi talking about we got to tackle climate change. It's like, it's the Stockholm syndrome, man. And that's why we just got to sweep these guys out, all of them, because we have the Stockholm syndrome. We just can't. We just want to be loved. We look at it, my horns. Oh, it's crazy. Yeah, right on, Eric. My dad turns 80. He likes cars. There was a store to few. You're right on, Denise. So he and his wife go to Arizona every year with their RV. Right on, man. So the 80 years old. You ain't dead yet, man. My grandma's 98 and just now went to assisted living. So Denise, basically, she's going to kick everybody's butt on here, right? Except maybe our IRS lady, Nancy. So Denise and Nancy can get into a cage brawl, but her dad is 80 and he's building vehicles, and her grandma's 98. So it looks like she had dad at 18 years old. I have a sneaky suspicion that some serious, probably Northern European stock, I would predict, because it looks like Denise got some yellow hair. There's probably some Scandinavian stock in there, and she'd probably kill us all. Yeah, right on. Tax code needs to be indexed for inflation. Yep, we've been saying that for years. And everyone from middle class Joe to George W. Bush and everybody in between didn't do a damn thing about it. They can all kiss my big fat behind. Tampa Bay Buccaneers. The Tampa, get it, Tom Brady. Yeah, right on. A cash value pension is 4.5% guarantee return. Yep. When Nixon took the USA off the gold, it's not true at all. The gold in Fort Knox was stolen. Is it not true? I don't even know. All right. Man, I'm not sure. Keep your body and brain moving and stimulated. Yep. Let's see. Cornbread. I can hear my son up there yelling. Biden has, so more people have died under Biden because of COVID than, 7 September 11th now. What's up, man, Biden? What are you doing? Why are you letting these people die? All right. Let's see. I agree with your prior full FRA analysis. For the post FRA to 70, don't you need to consider life expectancy in the analysis? Yeah, I mean, sure, absolutely. I mean, I think that goes without saying. Yes, if you're going to die at 73, you probably want to take Social Security unless you're married. I mean, don't forget, if you have a surviving spouse, my better half, old Shar, I'm 4 years older than her. So even if I kick the bucket at 71, I want to leave her the max amount for sure. But if I'm single, sure, absolutely. Absolutely. If I lose my job in February and take my 401k out of my 56-year-old, my only tax will be the total of my 401k. All right, so remember, just leave your money in the 401k, brother. That way, if you do take it out, it won't be subject to 10% penalty. Whatever you do not roll that over to an IRA, man. Negative. But yes, you'll have to pay income tax on that for sure. Absolutely. Pink Floyd is great no matter who's singing it. You got to give a down thing to that. Fauci in trouble. Anyone watch Hilton last night? Hilton? Who's Hilton? No, I'm not sure what that means. But I noticed that Fauci's backtracking on his 2 mask thing. I think Fauci has jumped the shark, I think, which is about damn time. Fauci's a fraud. Frauci. Yeah, I don't think there's going to be a cut in Social Security at all. I tell you, Dan Rostenkowski. All right, let's see here. They cut and Social Security gets closer and closer. Now address the problem. It's not in the horizon. It will be when it needs to be. That's for sure. Just like what happened in 1983. Yeah, that's what I was thinking too, Vinyl. A closed-end fund probably uses leverage. I didn't see any debt on the balance sheet. I just real quick cursory look. I think the same thing. They got to be using leverage. All right. Cash is trash. Send it to me. All right. I had a closed-end fund for about 6 years. At the end, after adding up each monthly distribution and value of the investment, it was about even. So dead money for 6 years. Yeah, man. Yep. Closed-end funds need to be carefully analyzed. Could not agree more. I was looking at VYM. I don't know anything. I just signed on to Robinhood. I'm going to use my only allowance to gamble on the stock. I have not been approved. I only put 25 to start. Okay. Let's see. Yep. Term limits. Yep. But also at each election, whether 4 or 6 years, the voters can turn them out. But the incumbents have a war chest to bet on, and they get the media, man. I mean, don't forget, I get every quarter, even for my state senator, Brandon Beach. You can't beat that advertising. It's supposed to be nonpartisan, but it says this is what we're doing. I mean, this is how it works. The incumbents are the incumbent protection racket for sure. Yep, corruption has been leveled at 100%, man. All right. Let's anything else on here? All right, my friends. So, anyone watch YouTube John Burke? Not familiar with him. Tom Shady. Oh boy. Wuhan Oil Company, right on, man. 100% Norwegian. I told everybody. Some northern Scandinavian stock. That's 100% right. Yep. AOC loves BOC. What's BOC? I'm not sure what BOC is. And now you recognize now too, they're starting to admit the Chinese virus came from a Wuhan lab. Remember, to say that was made you conspiracy theorist before. Now it's starting to become that it came from Wuhan lab. It's just the whole thing does. All right, my friends, I'm gonna go kick some butts up there. Get out of here. Appreciate y'all being here. I still got a bunch more questions to answer. So, I just fun doing them. I think what we'll do next time is I'll just open up for questions for y'all. Put a thing in advance. Oh, look at baby. Come here. Oh, Pablo wants to say something. Oh, look at baby. Hi. Do you have anything to say? You have anything to say? Hi, baby. Oh, he's so handsome. But I think next time I'll just put it so if any of you guys have questions, I'll just answer those. But for right now, it's just fun kind of going through these questions that have piled up. They're all good. They're all good, man. Don't forget to paw the like button. My name is Pablo. I live on the second floor. He likes to dance. I can't think of a rhyme, but he doesn't do it anymore. Oh, yeah, I love this boy. All right, guys. Thanks. See y'all. Appreciate you being here.